Hello and welcome to the third season of CNBC-TV18.com presents The Making in association with HSBC. India Inc. has been rewiring strategies to thrive in one of the most disruptive geopolitical and economic periods. Through season 1 and 2 of The Making, we captured the pulse of the Indian economy. Presently, India has been able to position itself as a leader with its economy continuing to grow, a flourishing startup ecosystem, adoption of digital solutions, and sustainability commitments. Now, despite the global disruptions, these pillars have charted a path for India to emerge as the fastest growing major economy in the world, with projections positioning our economy as one of the top 3 economic powers globally over the next decade. So, what will it take for India to truly achieve making this decade its own? Joining me now to discuss this and more is Hitendra Dave, the CEO of HSBC India. Hitendra, always a pleasure. Many thanks for joining us here on The Making. Let me get started by talking to you about the macros, Hitendra. As we pointed out, at this point in time, India looks relatively resilient in comparison to the kind of uncertain global environment that we're seeing. Most people do project that this could potentially be India's decade, both in terms of growth as well as future opportunities. So that's where I want to start with you. How confident do you feel about the recovery that we're currently seeing in India, and more importantly, triggers for future growth?
I would agree with the comment that you just made. I'm also part of that group who thinks the next 10, 20 years is really for us to make sure that by the time we achieve 100 years of independence, we've actually achieved a level of per capita income, GDP, consumption of various goods and services, which put us at par with the advanced economy. So clearly, it's for all of us to make sure we don't waste this opportunity. But just wishes apart, I mean, on a here and now basis, the health of any economy, any business, any household for that matter, I think typically depends on the balance sheet that we have. And I think when people are talking extremely positively about India right now, it's largely at a level talking about the health of the various sub segments of the Indian economy. So if you look at, let's say, start with financial sector, which I also happen to represent, I don't think any of us can recall a banking system balance sheet which is as strong as it is today, measured on any metric, right? Whether it's the level of capital respect relative to the risk-weighted assets, whether it's the level of provisioning against historically impaired assets, whether it's the level of liquidity that we are carrying. So clearly, to the extent that financial sector channelizes funding into productive sections of the Indian economy, that's one section which is absolutely in a position to do so and support so. Then you move to the household, or let's start with the corporate sector. Again, I think till about 5-6 years back, most of us had real issues with the amount of indebtedness that a very large number of Indian, mid-market and above Indian groups had leveraged themselves up, tanked themselves up with debt. The cash flows were weak. Bulk of the cash flows that were generated were largely towards repaying loans, and those who did not repay loans, obviously, then we had another chapter there, which is what we the IBC chapter, etc. So, by any metric you look at the number, the debt to equity, debt to EBITDA, or whatever, I think it's one of the lowest we've seen in the last 5-6 years. So the corporate sector balance sheet is good. You look at household, it's difficult to see household balance sheets because it's not printed in the way that we look at corporate or financial sector. But if you look at proxies, the level of impairments that lenders are experiencing in their mortgage portfolio, cards portfolio, unsecured loans portfolio, everything would seem to suggest that households above a particular level of incomes are obviously having it good. And finally, I guess is the government, which we know the debt to equity, their overall debt to GDP has gone up, level the stock of debt has gone up, but on a cash flow basis, whether it's GST, income tax collections, corporation tax collections, corporate tax collections, they're all growing at 20% plus, which you take any day, right? That's twice the rate of nominal GDP growth. So overall, yes, I think the next 10, 20, 25 years of India's to use or to lose. The balance sheets are strong in the short run, and I really think all of us have to now make sure that we grab the opportunity that is made available due to the factors that I just described, plus the opportunity that resides outside India as well.
Well, yes, it seems like it is a fairly long runway, but Hitendra, you talked about perhaps some of the policy decisions that were taken in developed markets, in developing markets, that has led to the kind of runaway inflation that we have globally seen. India also seeing a problem with inflation, but perhaps not as challenging as what we are seeing in the developed markets. We've seen central bankers move in a synchronized fashion, hiking rates across the board. What's the sense in terms of inflation, rates, and where we could potentially pause?
Yeah, no. So I think in your previous question, you had asked, you had asked a specific section on risk from an MSME lending perspective, but risk at a country level obviously will be, and this is, well, since we are in India, we're talking about India, but this could be equally applicable of any other emerging market which needs capital from largely from the West, and increasingly these days from the Middle East as well. That if the rates in the West start going towards levels which are more associated with our kind of rates, right? I mean, if the rates there are going to go to 4.5 or 5, then what is going to be the reaction of the people who are investing money, whether it is FDI or portfolio flows or private equity or whatever else? Do they choose to remain back home because the returns there are now sufficient to meet the investor requirements, or do they still come all around the world to find growth here? I think as a country, we just need to make sure that the process of making investments in India is as easy, as smooth as the journey is made it, is such that people don't think about, do I really want to go there? Secondly, I think manage the economy, households, financial sector in such a way that the growth prospects, people are going to come for growth, right? As long as we are a destination where high growth based on demand, based on low cost availability of labor and low cost of labor, quality of manufacturing, quality of service, etc. is there, I think we will attract the capital. I just wanted to make that point. But overall, I still think I will repeat what we said in the beginning. I think these 10-15 years are for us to use or lose. And I'm on the more optimistic camp. So I hope that each year when we look back, we've done justice to the opportunity that we are all presented with.
Yes, the execution challenge is one that we need to ensure falls into place. But speaking of future opportunities, and one space which has attracted a fair amount of attention is, of course, the startup ecosystem. Whether it's the number of startups that have emerged over the past decade, and of course the number of unicorns that continue to be minted week after week, month after month, and while we are seeing currently a slowdown in the kind of investment coming into the space on account of global conditions in the global environment, as well as a move towards doubling down on, cutting out unnecessary expenditure, focusing much more clearly on the path to profitability, how confident do you feel about what this leg of the story can do for this 5 trillion, $10 trillion aspiration that we have?
I think one thing we have to admit, in the last 5-7 years, if there's something which is really outstanding that's happened in our country, is this whole ecosystem of young individuals chucking up safe, highly paying jobs and deciding to go entrepreneurial. I think it's one of the great things that's happened. I think I mentioned previously also, the only thing you look back at is that, we wish during our times when we were younger, there was such an opportunity. And I wish I was courageous enough at that point of time to have taken such a call. But this is one of the brilliant things that's happened in India. I think the second thing I would say is, yes, there is a funding slowdown because of the interest rate, liquidity, all kinds of things which are on play right now, valuations, and as interest rates go higher, businesses that were able to discount, let's say 10 years hence, 20 years hence, cash flows to today at discount rate of 0.5%, 1%. But when you discount the same at the current treasury rate of 4 to 5%, obviously the present value does come down. So we are in that period right now where valuations are getting reassessed. The seller is still, I guess, living in 2020 and 2021, and the buyer has moved into the 2023 and 24 period. So that's what happens in financial markets all the time. But having worked very closely with many of these startups, we bank almost 1,000. We bank about 44 or 45 of the unicorns, and having known many of these people, I think the work they are doing is really, really good. That doesn't mean all of them will flourish. It also means that some of them will actually maybe even fail. But the good part, like I said, is failure has become acceptable, which wasn't the case 10 years back. If you wanted to start a venture, it had to be so safe. It was not entrepreneurial at all, right? So I think that's the good thing here. As HSBC, we are very excited about this development, right? I mean, we're excited as a participant in the country. We're excited as a management team. We're excited to make sure that these entrepreneurs who are really, really toiling very hard, I think their work ethic is absolutely brilliant, that we are also trying to back them. So we bank about 1,000 startups. We bank about 45 odd unicorns. We've announced a $250 million fund, debt from normal working capital facilities to lend to startups. And the main thing we look for here is A, governance, B, skin in the game, and finally, of course, the basic business proposition, I think, as long as it appears to make sense to us. So we are doing everything we can to further this very exciting macro development that has taken place.
Speaking of exciting macro developments and potential growth opportunities, I want to talk about three potential growth opportunities where the runway for growth seems fairly significant from where we currently find ourselves. One, of course, is the real estate space, which has bounced back and continues to see a recovery, and a fairly strong one. I wanted to know what your views and your thoughts are there. Second, the retail opportunity, the consumption patterns changing, online becoming much more of a thing, and what that could potentially mean, not just in the urban cities, but opening up of tier 2, tier 3 towns as well, with the access deficit being reduced there. And number three, the transition to renewable. And that, of course, presents itself with challenges, but equally with opportunities. How do you see these three pillars, so to speak, for future growth?
So if you look at real estate, my own sense is partly it is what all of us experienced as people who had to be cooped up inside our houses, and the result of that, all of us wanted the extra room for the the study, for the school, for if there's a couple working, then they both needed the privacy, etc. So I think partly it is a result of that, but a broader, I think, is also linked back to what we started this interview with, household balance sheets. I think it is a fact that the top 20-25%, going maybe all the way down to 50%, has had it quite good in terms of buildup of savings, rise in incomes. For those in the formal sector have actually experienced reasonably high wage growth, which has been faster than inflation, etc. So, and similarly on the commercial real estate side, whether it is malls, whether it is office space, etc., you get the sense that this 30 to 50% or this 20 to 50% is able to currently carry the demand with it, despite some of the changes which are linked to work from home and things of that nature. At least the engagement we have with senior stakeholders in the real estate sector space seems to suggest that this demand, they think, is more structural than just a cyclical 6 month or a 1 year one. And that's reflected in everything, right? Stamp duty registrations in Mumbai, number of people who are moving from 2-bedroom to 3-bedroom, or 3-bedroom to 4-bedroom, or whatever, things like that. I think on renewable, as you mentioned, there is this is one of the most exciting sectors to be, and renewable can be sort of equal to solar or wind, or we can see it in a larger, broader category like electric vehicles, battery storage, and just household, etc., etc. So it is very clear that I think what is going to happen is, as oil prices remain high, and I read the minister's comment 2 days back, one of the things is it is bound to do is to trigger a faster movement towards machines and any other thing that consumes conventional fuel. So I think India is going to be absolutely at the cusp of building the largest stock of renewable energy capacity, will be one of the faster adopters of electric vehicles and two-wheelers and things of that nature. So again, as a bank, as a country, I think that's one of the things which should help us move from this 3 to 5 trillion in a faster time frame than perhaps, because it's completely fresh investments, right? Sorry, which was the third sector, Shereen?
Retail.
Yeah. So I think, again, this links back to the earlier point about, as long as the 20 to 30%, which might be very small in any other country, but 20 to 30% in India means 20 to 30 crore people, right? That's not a small number, which has had, because of pandemic, a different approach to life. So you go to restaurants, you go to shopping malls. It is likely that the higher end segments will continue to do well for the foreseeable future. But if we are to go from 3 to 5, and which I think is, I should drop the if, when we get from 3 to 5 and beyond, and some of the effects of PLIs plays through, some of the effects of doubling of agriculture income plays through, some of the effects of better infrastructure, logistics play through, you would expect some of this to flow through. And you can already see, right? You can see it in the number of tier 2, tier 3, tier 4 towns where the demand for many goods and services already matches, not like for like one city versus one town, but 10 towns versus one city. And you can see it there. And therefore, I think you're even seeing IT companies going to tier 2, tier 3 cities for other reasons, real estate, wage cost, etc. So overall, yes, I think between retail, real estate, and renewable, these are the three sectors that should play a meaningful role in the journey to 5 and beyond.
With India's ambitious clean energy